Everybody to our webinar today with the title Investing and Exiting Late-Stage Primary and Secondary VC Deals. I'm Ronald. I'm going to be the host for you for the next 45 to 60 minutes, and I have the pleasure, or I should say honor, to have a guest from the Silicon Valley with us, Skyler Fernandes, who will introduce himself in a minute because he did way too many things in the past and I would make mistakes introducing him. But before we hand over to Sky and to our agenda today, rough outline of today's agenda will be for the next 45-60 minutes, a short introduction of Sky and his activities at venture universities and his background investing in a plethora of primary and secondary deals. Then we dive into our main agenda points. We'll tackle those in a bilateral setting. And this will be followed by a hopefully lively Q&A session. So we try to stick to half an hour, Sky and me max, and then obviously we open the floor to the audience. Having said that, I would hand over to you, Sky, for a short introduction of yourself and Venture University.
Cool, yeah. Thanks, everyone. I appreciate everyone joining. So hi, I'm Skyler Fernandes. I've been doing venture capital my entire working career, so about 17 years now, doing venture capital investments. I've done now about over 170 startup investments. So I've been averaging roughly about 10 deals a year for the last, the last 17 years. It's ranged really from investing in pre-seed, where you have pre-revenue, pre-product companies. Also been on the operator side of operating companies and co-founding a number of companies, including VU and all the different companies we have under the VU platform. And we've also, in the more recent years, have started making a number of later stage secondary transactions as well. So kind of truly having the full spectrum. In terms of the VU platform overall, we have our core venture capital fund called VU Venture Partners. We're an early stage, growth stage, and global venture capital fund. And so we launched VU as a platform about 7 years ago. But we're a truly global team with offices across the United States, Western Europe, Eastern Europe, Asia Pacific, and Latin America. And then we have our private equity fund, which is real estate private equity investing. And the VU for VU Venture Partners comes from Venture University, where we are an investor accelerator versus a startup accelerator, where we train and educate people to learn how to do angel investing, venture capital, and private equity. We've now graduated about 750 people from the program, where they go through an educational portion, where we have a masterclass, advanced modules, and fireside chats, as well as an investment apprenticeship, where individuals join our venture capital fund or our private equity fund, focus on deal sourcing, due diligence, and making investments, where we do up to about 7 investments every quarter. And people can join us for 1 quarter to 4 quarters, where you'll make up to about 25 to 30 investments over the course of the year. And everyone receives a profit sharing agreement where you receive upside in the investments that we're making every quarter. So you really do get to learn by doing, which is great. And then in terms of the background on myself and the other partners, collectively across the partners, we've now invested about $2 billion on the venture capital side, about $7 billion on the real estate private equity side. And we've been early investors, and in some cases, even some of the largest investors in over 25 unicorns and over 20 multi-billion-dollar exits, where we've either entered at the really, really early seed stage, or we've been entering at the later stages as well. But key thing there is that we have a net realized return of over 4x cash on cash on that return, which is important not just to be investing in unicorns, because there's also things called unicorpses, where unicorns eventually die and you don't get any liquidity. So important to actually get the liquidity side as well. And that's certainly something that the secondary market is definitely helping with in creating liquidity in a time when there's not that many IPO or M&A transactions. Obviously, this topic is very topical, and it's a number of ways of how LPs and funds are getting liquidity in the last few years, and we'll likely see that for the foreseeable future.
Brilliant. Thank you very much indeed. That was concise and comprehensive. So I'm trying to set the stage for our agenda. In today's market that is obviously constantly evolving, late stage venture deals, I mean, whether primary or secondaries, present unique opportunities, but also challenges. And today we want to explore how leading investors like Sky and Venture University are navigating valuation shifts, liquidity constraints, and exit pathways in this space. So looking forward for that to a dynamic and insightful discussion, and let's dive in. Our first bullet point on our agenda is why secondaries have become such an interesting exit route over the last, say, you said it already, 2 to 3 years in particular.
Yep. Yeah, I think it's interesting. If you, I think certainly probably the biggest driving factor has been the lack of kind of IPOs and M&A activity overall, and that's a factor. I think of a number of situations. One, I think that there's a market economy dynamic that's at play, but I also think that there is an interesting underlying topic that probably doesn't get talked about that much. Which is really the benefit for companies to stay private longer, and we're kind of entering into this new era, what we call the chimeras versus the unicorns. This idea that companies that are now public that are certainly worth over $1 trillion. We have about 7, 8 of those now. But we're now seeing that there's a number of private companies that are starting to get to these pretty significant valuations. And I think there's a lot of incentive to actually stay private longer. And so by the time some of these private companies do go public, they'll go public at probably $1 trillion plus valuation. And so I think there's a lot of reasons when you're still in high growth mode, there's benefits of obviously staying private and not going public yet. But yeah, I think the time horizon of getting liquidity has certainly extended itself. There's even some venture funds that have been created in the last 5 to 10 years now, where they're beyond kind of a 10-year fund play. They're even doing 15, 20-year funds, knowing that they're going after some of the largest, most disruptive opportunities, but those might take a little longer than just a 5-year period. And so I think you're seeing a change happening there. But in terms of LPs greatly want liquidity. And so the traditional means of just waiting around for an M&A IPO is not ideal for them. And so the idea of how can we more professionalize and streamline the process of creating liquidity. And so you've had a number of these marketplaces that have now been created, in some cases by really, really large family offices that have actually been the creator of some of these marketplaces because they're already investors in lots of funds that have these allocations in deals, and kind of saying, hey, if they can do it themselves, let's open it up for a broader world overall. And I think there's also the other big part of this is that there's been a lot of standardization in the world of SPVs. The cost of creating SPVs has come down significantly, the time to set them up. And I think people are becoming more comfortable with the world of SPVs. And this has also kind of unlocked new ways of creating liquidity in the secondary market that wasn't possible before. So you do have a number of SPVs that are also investing into SPVs with multiple layers, but that's also helping to create kind of a broader entry point and liquidity for investors in this market. So I think you have a number of different dynamics at play that's now making this a more transparent market, but at the same time, it has a lot of gray area that in complexities, given that it is kind of a new Wild West in this world of secondaries. It's certainly not as transparent as the pure public markets are.
Yeah. I mean, from SeedBlink Group's perspective, we have a secondary marketplace there. We see increased activity on secondary paper floating around, especially over the last 18 months, I would argue, for exactly the reasons that Sky mentioned. Although I would admit, and obviously always looking a bit envious towards the States, Europe is lagging behind a couple of years. That's the nature of the game. And I think the depleted or non-existent exit route with respect to IPOs, which is as rare as a unicorn even in Europe, combined with a low M&A market activity, just drove a lot of investors towards exploring secondary deals. I mean, put one and one together, and this is what you get.
Yeah, I think the other thing actually to bring up there, by the way, is like there's this new concept just in the last like 5 years or so of the kind of quote unquote private IPO. This idea that you end up raising effectively a pretty sizable amount of capital that you would have raised by going public, but you're now raising it from a private means. If you look at all the transactions that have happened just in the last 2 years around like OpenAI, Anduril, SpaceX, these are massive, massive rounds that normally wouldn't have happened, but yet the same people that would have been buying in to the IPOs are now just buying in through these secondary marketplaces, or through this organized channel that's done completely privately and not publicly.
Yeah. Coming to our next point, venture capital secondary market activities, drivers, trends. We already touched upon a couple of things, but where do you see the trends going forward? Where do we stand?
Yeah, absolutely. Yeah, I think the human civilization right now, I think, is entering into a pretty interesting next like decade to 2 decades. We're kind of transitioning from what I call like the excitement around the purely, bits and into the world of atoms. I think some of the most exciting things that we're investing in is this optimization and capital efficiency of atoms versus bits, and also kind of the merger of the two of them together into opportunities. And so I think if you look at where the most massive market opportunities are today, you see that they're like the initial era of unicorns and these chimeras, what we call trillion-dollar plus companies. They initially started off as being more digital oriented. Now you kind of see this next generation that are a lot more on the atom side or a merger of the two. And what's fascinating, I think, by the overall trend is that the biggest opportunities will maintain themselves as being ones that are both for consumers and enterprises. In fact, if you want to get to the highest possible valuation, you need to be effectively targeting both consumers and enterprises and have almost everyone on earth as a potential customer. And those things are becoming more actionable than they ever were before. So I think just like you saw, unicorns were once rare, and now you have over 1,000 unicorns. The next decade to 2 decades is going to be defined, I think, by the rise of chimeras over unicorns that are also eating unicorns for lunch and kind of their acquisition of them at the same time. But I think the vertical wise, I think you're seeing things around, biotech and longevity is certainly becoming quite interesting. The world, obviously, of space technology, we've seen some of the highest interesting capital efficiencies in the world of space tech that would have never been actionable for, pre-seed, seed Series A rounds. We've had some great success. About 10% of our portfolio is now in space tech. And I think in the frontier space, in terms of AI, robotics, and the combination of the two, that's also been a huge growth area for our own portfolio and successes in the portfolio. But I think all of it represents, whether it's, again, biotech versus just bits.
That's a very interesting statement from bits to atoms. I like that, and I learned the word chimeras already today, so that's a good one. We see it as well, quite frankly. I mean, obviously, you have the usual B2B plays in Europe, like the Klarnas and to some extent the vast majority of scale-ups unicorns being B2B. That's inherently a European thing. It's different in a homogeneous market like the US or China, for that matter. So that's interesting. And we're also having currently Figure AI on our platform. It's very sought after by
Yep.
by European investors. So that's
Yeah,
interesting.
you also find with the difference between, I think if you're looking at like an OpenAI versus like a SpaceX or a Figure, one of the things that because we're an investor in all of those companies, and the sustainable competitive advantage, I think, is also very interesting between bits and atoms. You have a faster closing of the gap that can happen, certainly in the world of bits. But in the world of atoms, like if you're SpaceX and you have 80% of all the satellites that are up there, that's not something that can be just instantly replaced with, better code or advancements. And so there is a more sustainable competitive advantage in the world of atoms versus bits, which I think is fascinating. But it's also harder to do. It's hard stuff, obviously, with atoms. And so I think that's another interesting element that we're going to start seeing is just this other capital efficiency and speeding up of innovation on the physical world.
Yeah, hardware is hard, as Mr. Horowitz famously said in the past.
Exactly.
But I like your comparison with having a deeper moat when you're going towards the atoms instead of the bits. I can fully relate to that. I mean, that's what you want to have at the end of the day. But it's hard to get it off the ground, especially because it's costly. It's just extremely costly. And but then we see the rise of deep tech in Europe as well. I mean, again, the US is always 10 years ahead, so I'm not surprised. Talking about exits through secondaries, when you would compare those to the classical M&A and IPO exits, what differentiating factors you see there?
Yeah, I think that's an interesting point. As a venture fund, we've been really focusing primarily on doing the later stage deals where there's still significant return profiles. We'll selectively still do ones that, where the return multiple might be less than a 10x, but the ones that we're really adding from a fund perspective versus what we're doing on the SPV side, when our committed fund is investing, we're still very much focused on returning 25 to 100% for every investment. So real life example, that's always good to see. If you look at our early investment in Figure, we entered Figure at a $2.5 billion valuation last year. And at that point, the company was pre-revenue, pre-product. And some say it's like, well, that's a really high valuation for pre-revenue, pre-product company entering at 2.5 billion. What we also teach at Venture University is it's the return multiple of what could happen in the future that matters, not the entry valuation. And we've had that true from being early investor in Uber, coming in at under a billion, exiting at 40 billion, Twitter getting in under a billion, exiting at 19 billion. Nobody gets mad if you're still getting, 10, 20 X's plus. And so with Figure, when we entered a year ago at 2.5 billion, fast forward now to 2025, the company then raises their next round at a $40 billion valuation, and we're 15x from last year. And if we look at the logic when we first entered, we believed that Figure had a line of sight where it could be worth 10 to 100 times the initial entry valuation. So we entered at 2.5 billion. We saw that this company could be worth 25 billion to 250 billion, could even be worth over a trillion. But we felt pretty good in that like 25 billion to 250 billion range. Now it's at 40 billion, 15x. And if we look at the initial check that we did, we then doubled down on this follow-on round, and we're now positioned where Figure, could 1x or 5x our entire fund, even when you're entering at that late stage. So just because you're entering at above a billion doesn't mean you can't still get potentially a 10x to 100x. It's rare. There's not that many opportunities that can obviously be worth $1 trillion or even 250 billion. But there are select opportunities where we believe that's true. On the other side, we're doing investments like in Angel or Neuralink, where we think there's significant upside, but we think we're kind of in the ballpark of like a 4x to a 10x. We don't think that there's as much juice there, but still a well worthwhile kind of de-risked play than if you were entering at pre-revenue Series A, Series B.
Got it. Looking at it from your VC angle, how do you spot momentum for secondaries and late stage investments, i.e., what needs to happen for you to consider buying batches of secondary shares?
Yeah, absolutely. Yeah. So we typically don't focus too much on like what's hot in the market. So there are the list of like the top, 10, 20 secondary opportunities. A lot of those I wouldn't touch. And a lot of them we're also like much earlier investors and we've been selling along the way than we would kind of enter. One example I would say is like Databricks. We were early investors in Databricks and we've sold almost 90% of the stake along the way from my partner Andrew's early investment in the company. But at this point, I think Databricks is maybe like a 2 to 3x, but it still could be like a good deal. But if I compare that from like the timeline of investing in like real estate private equity, I could also get a 2x in I think roughly the same time zone of like 5 years. So I'm not sure completely risk return adjusted on that side for certain opportunities. But yeah, I think the overall what we focus on when we're choosing to do the deals, our main filters are certainly on market size. We really focus on are we going after the largest that are market opportunities that are actionable at this point in human civilization? And being wrong on market timing is definitely the same thing as being wrong. I invested a decade ago in enterprise augmented reality. That market has still not arrived, and so I'd still be waiting around for any revenues to happen. And so I think market timing, but also that you really are going after truly calculable largest market opportunities. And some of these things are calculable and some of them have a big unknown. Like Neuralink is a good example. There's a certain market for, the unhealthy population that Neuralink could serve. That itself is a pretty decent sized market that we think it can be worth a lot of money. But the real unknown with like Neuralink is whether the healthy human population will ever adopt Neuralink. And if that happens, the market valuation is completely different. If everyone's walking around with Neuralink and there was nothing wrong with you to begin with. And so some of those you're kind of taking upside potential, which is not required, but it's a huge unlock if it happens. And then after market size, the next biggest filter that we look for is really on magnitude of improvement. We put a pretty big weight on this when we're evaluating companies internally. Are you doing something that's an iterative improvement versus really a magnitude of 10 to 100x improvement? Directionally, this is why I've kind of stayed away from some of the AI companies where they don't actually, haven't not built their own LLMs, where I think it's more of a layer, and I question what the true long-term value is for certain types of approaches that are layers versus building a fundamental asset. And so I think the magnitude of improvement versus iterative play is key. And then we also look for do they have a really clear channel for mass market adoption? And so that's another big one where there's certainly companies that have raised a lot of money and then they've launched and have gone nowhere. Humane is one that did that more recently, which was, a lot of hype around it. And the second it launched, it was also dead. And so, you have to be careful about that as well. So I'd say overall, is there a true, path to mass market adoption? And is it actually even solving a problem at the end of the day?
Got it. Just out of curiosity, do you have at Venture University Fund consistent strategy when it comes to secondaries, i.e., would you sell at a certain multiple? So something you follow religiously, or do you kind of play by ear a bit?
Yeah, absolutely. Yeah. So on our committed fund, we would only participate if we can return 25 to 100% of the fund. So the fund has invested, for example, in OpenAI and SpaceX, but we did not do Anduril and Neuralink. On the same time, though, we have our syndicate, which invests deal by deal. For those, it's great to be able to create allocations and opportunities for our investors to do deals like that, but it's at a lower return multiple overall. So I'd call it, for the most part, if it's like under a 10x, it might be appropriate for our syndicate, and a lot of family offices are still happy to do those deals, but it's not fitting for our really focused on the venture fund side, where every deal needs to have the return potential of returning 25 to 100%. The logic around selling over time, that truly is just on a case by case basis on the opportunity of whether or not, if the next round or two rounds from now there's an opportunity where we can sell 25% to half of our stake. I would say that there's certainly a logic where if you can at least get your principal back of how much you've invested, then you're kind of just playing with house money at that point, and just playing on the upside. So usually, if I had to go with a strategy on selling on the secondaries, it's at what point could we do it where we would get our principal back, but still kind of have a good multiple above that. That's usually one logic that we hold on to. I'd say for the long term, we're still looking to probably hold in most cases for kind of like a 3-year to 5-year timeline for a lot of these opportunities where we're going to get enough of an increase in valuation. And then I'd also say that if you stick to the bigger brand names, like a SpaceX or an Anduril, it's likely that for the foreseeable future, there'll be a decent amount of liquidity in the secondary market, where if you try to, sell, there's probably a buyer that you can find on the other side. That's certainly a challenge if you're doing early stage companies. The demand and volume doesn't exist. We had this happen more recently. We had one of our portfolio companies called TouchCast was acquired for 500 million. We invested about 12 months beforehand, so it was a short hold period. We made a 3x in 12 months, which is better than a stick in the eye. But we got part of it in cash and we got part of it in shares. And so we looked on the secondary market of like, could we offload the shares that we got as part of the acquisition? This company that had bought them is called Infinite Reality. They're now worth about 15 billion. But most people have never heard of Infinite Reality, even though it's worth $15 billion on paper. And so, if we looked at what the market was there, while some of the brand names you can kind of sell for current share price or maybe even a premium, with most of the market, you're looking at like a discount of 10% to 80%. And with, Infinite Reality shares, if we were to, find a reasonable price for it, you're probably looking at about a 50% discount. So our 3x probably becomes like a 2x for the amount that we had in shares. And that's still pretty good. In the world, if you're still trying to create liquidity, a 2x is still better. You might not be able to get the 3x, but you need to find actually a buyer on the other side. And that's the challenge. That liquidity only really exists, I'd say, for the most well-known companies, and certainly not if you're only worth over $1 billion.
Got it. Makes sense. That brings us to the next point. What are the key criteria in your view for evaluating a secondary trade from a seller and from a buyer perspective? We touched upon a couple of things already.
Yeah. No, but the good points. Yeah, good questions and good points around that. So certainly the riskiest part of this market and the secondary side is buying from a trusted party, right? Where you actually know the chain of custody. You know that the person actually does own the shares that they're selling. I think that's the biggest risk overall when I think about this market right now. As an example, like when I did the SpaceX transaction with the third party that we were working with, which we've done a number of transactions with them, so they become more trusted just because we've been working with them a number of times. For the SpaceX shares, I saw with my own eyes the stock certificates, and I saw the name of the family office on the stock certificates. And this particular large buyer was buying about $200 million of SpaceX from this family office. And so had confidence because I knew that I knew about that family office. I knew that they'd been a long time early investor in SpaceX. And there's a lot of reasons of why certain family offices and certain VCs don't want to be known publicly that they're selling their SpaceX shares or selling any shares. It either might be more legally complicated for them to be, selling directly, and so they're doing it in this kind of gray world where they're pledging the future value, of the SpaceX shares. We're not going to be on the SpaceX cap table, and I think it's also kind of ridiculous for a lot. Sometimes we get investors that ask us this question of like, can I buy through VU to be on directly on the cap table? It's like the SpaceX is not updating their cap table, and OpenAI is not updating their cap table for like your $10,000 check. It's like not happening. So sorry, and that's the whole benefit of the world of public markets is you can have the ledger is changing rapidly, but it's just too annoying for a large company to effectively do that. So it's a ludicrous request in these cases, and so this private market where you are either getting pledged the value of those future shares upon like an IPO is the only way that these kind of transactions work. Or you can do a transfer, within an SPV of ownership. That you can certainly do on the ledger. You can transfer within an SPV, but a lot of times it's this pledging aspect. So I'd say chain of custody is important. The other one is understanding all the fees. You have the elements around a lot of times, the fees are kind of confusing for people that are first time looking at this, where they'll say, I'm looking for like a 0, 0. It's like, what the hell does 0, 0 mean? It's like, I'm looking for like where there's like a one-time transaction fee and no management fee, no carry. And a lot of times you'll find like that one-time transaction fee can be like 5% to 20%. And then some people say, I don't even want a transaction fee. I don't want management fee. I don't want carry. It's like, oh, okay, well, then I can sell it to you at a share price that's 20% higher. It's like, which way would you like to pay the fee? I can tell you there's no fee, but charge you a 20% higher share price. Or I can just sell you for the share price that it's currently at, but charge you a one-time fee. Or I can just charge you no one-time fee, no increase in share price, but do a management fee and a carry. And so at the end of the day, there needs to be value for the creation of, creating the allocation and securing the allocation. There needs to be value for the due diligence that may have been done. Like we put together an internal report for every company that we're investing in. So you could see our evaluation of SpaceX or OpenAI. And so you have to say, is there any value for doing that? We might have, like, obviously people know that these companies already exist. So we're not sourcing the idea of investing in them for the first time. But there's not a lot of, there's some public information if you Google or use OpenAI to search for stuff, but there's still a lot of due diligence that one can do. And whether you have the time to do it yourself or not, that's the benefit of investing through a player like VU Syndicate, and doing these transactions. But I'd say the key thing there is, yeah, probably just make sure that you understand all the layers of fees. So you know what the gross fee is versus just the net fee on the particular SPV that you're investing through. And the idea that you could get into a lot of these deals now for the first time at really small check sizes. You can now invest in these deals at $5,000, $10,000, where before you would have, if you were go upstream, your minimum check has to be 500,000 to 50 million. And so there is, I think, this opening of the door now because more SPVs are involved. Smaller checks are now opening up for the market for a broader audience to participate in.
Now I do understand better what you meant by Wild Wild West in the beginning. All right. Last 2 bullet points. Penultimate one. What separates a great exit from a missed one? That's a bit of a provocative question, but see how you go about that one.
Repeat the question again. A great exit versus a missed one?
Yeah.
Yeah, I'd say there's an expression where you can, you get rich by selling too early. I think if you have the mind frame that you're just going to hold all the way until the company goes public or gets acquired, I do think you'll probably lose out on what your final total return could have been. There's mixed bags. You have like companies like venture funds like Sequoia, which are now playing more of an unconventional role where they're holding the shares of their portfolio even after they go public, and they're kind of managing them on the public side, because they saw that they could have had better returns for their investors if they didn't exit kind of at the IPO or pre-IPO. But I'd say, yeah, be judicious. I think you're going to have to make the call of how much more juice really is there in the companies that you're investing in. And so I think working with a professional manager that is paying attention to this stuff and not just waiting until you find out that the company went public is a good idea. But I think at the end of the day, anything above the money you put in, I'd say is a positive return. And so I'd say for overall, you're not missing anything as long as you're making money on the overall exit side. Could you have made, a 20x instead of a 10x? For sure. But you can also redeploy that capital into new opportunities. And if you're making a 2x every 12 months, you will do just fine economically for investing, and you'll outperform most if you're even just getting a 2x, let alone like a figure getting a 15x in 12 months. Like we also could have sold, all of our shares in figure just 12 months later and made a 15x. But you got to make that call of how risky you want to be with the overall stake, but just focus on making money and not losing anything.
Makes total sense. Never underestimate the liquidity / opportunity costs, obviously.
Yep.
The last point, when not to do secondaries.
Yeah, I guess, yeah, when not to do secondaries. That's a good question. I'd probably say in opportunities where the risk is higher than the return. So again, example like Databricks, for me, like I'd rather just put more money into our real estate private equity fund than put in Databricks right now. I still think you can get a good 2x. I'm just like, but the same risk, same return profile, but the much higher risk. So I'd probably say there's a handful of people that are probably getting overly enthusiastic on brand and not about underlying quality of the companies. Again, I'm still a huge fan of Databricks overall. The point is just you got to make sure that the return makes sense there. A lot of times with the secondaries, if you're doing valuations that are not rationalized, I think you're going to find yourself in a really bad territories. And so by the time the company does go public, you might find that the rationalization really hurts. I'd say again, if you look at companies like OpenAI, SpaceX, they actually have really rational revenue multiples right now. Where OpenAI and SpaceX, they're trading at like around 13 times revenues. And so it's not that crazy actually for their valuations. But if you are coming in where you're coming in at like a 50x, 100x revenue multiple, be careful. So I think you do need to start rationalizing sooner when you're doing this, and that's where while these companies are private, you don't always know what the revenues are. You can try to use as many triangulation of data to try to figure out what those answers are to the best of your ability, or work again with trusted partners where we're trying to figure that ourselves for the company. So yeah, just be careful with the same thing is true in just venture on the private side for primaries. Is investing over your skis at really, really high revenue multiples has turned out to be a bad strategy. Typically, the rule of thumb is that you should, if you're going to be investing at a higher revenue multiple, do it where it grows into the valuation over the next 12 to 18 months. That's usually considered acceptable. But beyond that, I'd say you're kind of in scary territory.
Got it. Cool. Thanks indeed. This was the last point on our agenda, and we open the floor or the Q&A session. There is a Q&A button in the bottom, which somebody already used. Feel free to use that one to ask any questions you may have for Sky. So far, the 2 questions have been answered, but they were more of technical administrative nature, I would say.
No worries, yeah.
Or maybe can you give us a case example while we wait for any questions of like when you did a really successful deal, a secondary deal, you don't need to mention any names or something, but where things just played out exactly as you planned?
Yeah, I think Figure is definitely a good example on this. When we go after largest market opportunities, the future of general purpose labor, it's hard to find bigger markets than that. The idea that there could be a humanoid robot for every person on Earth, or even more than every person on Earth. You get to just, we're estimating with Figure, for example, it's like over $40 trillion true market size for them, where it can do enterprise solutions, but also, consumer, at home, services as well. That's turned out well. Again, we thought that it could at least go to 25 billion to 250 billion. It's now at 40 billion. We think there's a good case now that it can go to, from 250 billion to over $1 trillion. But it's backed into like, I think solid logic in terms of revenue that they currently have. So example two is when we invested in Figure initially, it was pre-revenue, pre-product, but then fast forward 12 months later, they now have, two main clients that are effectively a $10 billion in contracted ARR. And so at 40 billion in valuation and 10 billion in contracted ARR, it's valued at like 4x contracted ARR. So once it becomes realized and it's more like a true SaaS part of their revenue, then you'll certainly be trading at 7 to 10x plus that. But because it's contracted revenue and not yet realized, like 4x is kind of already discounted on that. So I think Figure is actually pretty rationalized on its valuation at 40 billion. Yeah, I think the next inflection point for Figure is probably going out to raise their next round in about 12 to 24 months. And that'll probably be at like a 2x increase in valuation. If they just go from like two clients to like 4 to 8 clients, I think they'll be able to be in the ballpark of being worth 80 billion to over 100 billion. And at that point, I think we'd probably be open to selling a portion of our stake. We entered at 2.5 billion. If we got out around 100 billion, we'd be at a 50x, prior to any of the dilution. So, and still have plenty of upside above that. So.
Makes sense. And I find it interesting, and I swear to God, we didn't speak about this prior to this call, but we're currently having a batch of Figure AI on our platform as well for our valued investors for the
Oh, that's awesome. Yeah.
evaluation data points that Sky just mentioned. So I don't want to do any marketing thing, but in case you're interested,
Yeah.
in case you're interested, we didn't talk about it. I swear to God. All right. Let's see. Do you see SpaceX at risk due to the Trump-Musk spec?
Yeah. Oh, yeah. Standard good question. Yeah, I think overall, a lot of the Elon companies, I think they exist from a value perspective beyond the economic cycle, beyond the political environment of who's present at any given time. SpaceX is something that effectively the world needs, not just the United States needs. The world of kind of transitioning from NASA to SpaceX effectively in the overall enterprise. I think it's something that we can't live without. So I think there'll be some fun soap opera, things that happen in between that make for fun, fanfare. But yeah, I think that those are the minutia of the journey. I think the long-term play of what SpaceX is doing doesn't change. Like the demand for SpaceX is not going to change overall in the United States and globally. And if the United States did cut back on using SpaceX, like we then would be less advantageous in our space positioning for the United States. We're not going to do that. So it would come at the detriment from an ego perspective. I don't think that would. I don't think the ego is so strong that you'd hurt America as part of doing that. That kind of is counterproductive in the grand scheme of things. So yeah, no, I think overall SpaceX long term will be fine. I think there's a really long game there for SpaceX that it's scales over the next 50 to 100 years of what's being built at SpaceX, and I think it's a foundational company that's going to lead to a large future of the overall space economy. That's why it's a big investment in our own portfolio, but we're also investing in a lot of other companies that are building on top of that as well. For example, one of the things we believe that as SpaceX is bringing down the cost of getting to space, the next biggest challenge is that there's nowhere to go once you're up there. And so we think the next biggest opportunity is one of our other portfolio companies called Max Space, MAX Space, which is building real estate in space. And if you think on Earth, the biggest market on Earth is real estate. And so investing in the future, real estate developer, building the largest amount of volume of real estate in space, we think is going to be the next biggest opportunity after SpaceX. And you think about it, real estate itself in space is everything about the space economy from enterprise, government, consumer will built on top of that. And I think that's the things that SpaceX is now making more possible because of the reduction. As we get to Starship, we bring down the price per kilogram down to about $100 or maybe even less. And so it starts even becoming competitive to like sending something from the United States to Asia from a price point perspective. You get down to like $10 a kilogram. So.
Makes sense. Interesting. So we have another question. How do you assess the potential of AI tech? Do you have any framework that you use to assess where you see AI adoption actually pick up in the short and medium term, next 2 to 5 years?
Yeah, I think we're pretty consistent no matter the category that we're investing. We're a generalist fund, so we invest in every vertical. We have six different vertical teams with specialists in every team. I think it goes back to is it a large market opportunity? Is there a big magnitude of improvement compared to status quo? Is there a path to getting mass market adoption? And then also elements around the founder. Are they a founder that we believe has kind of a secret that they've unlocked? Or kind of unique skills that'll give them advantages for executing this. And then obviously having who your co-investors are is helpful. If you have deeper pocketed co-investors, you're not going to run out of money. But no, I don't think we have anything in particularly specific for AI companies that we look for that we don't look at any other company. So we're pretty consistent in the core things that matter whenever you're investing in any company. That's also what we train people at Venture Universities. We kind of go over our 12 criteria with key questions for every criteria, and then where we kind of put the bigger weights of the decision. Looks like we have another question here about investing in Indian startups. Yep. So yeah, we definitely invest in Indian startups. We have our Asia Pacific investment team, and we have about a third of our portfolio companies that are outside the U.S., and the largest portion of that is in Asia Pacific.
Where is that office located? Just out of interest.
The office is in Hong Kong.
Hong Kong, right?
Yep. Yeah, but we have a pretty sizable portfolio in India, Singapore, Australia, Hong Kong. So we have portfolio companies across each of those countries.
Any particularities for these countries when you compare it to the US, like
Yeah, I'd say
administrative
within like the frontier emerging markets, I think fintech is still like a really big category for them. It is fascinating. It hasn't like that's been the case for about a decade now, is that fintech seems to be a bigger catching up the curve to the US. I'd say the world around biotech is definitely pretty advanced in Asia. Some of that is from a regulatory perspective as well. Like we have one of our portfolio companies, which is still in stealth mode, but they're about to come out of stealth mode in the next like 2, 3 weeks. But they're an artificial womb growing an embryo all the way to full-term development, and that's an Asia-US kind of effort. And it's likely that the first animals grown in artificial womb and the first humans will probably be grown in Asia with our portfolio company before being brought to the US. And yep, yeah, we invest in pre-seed all the way through growth. So pre-revenue, pre-product. There's nothing too early that we don't invest in. There's also nothing too late stage that we don't invest in either. So we're just investing in ideally the best companies that are actionable at this point in human civilization is our focus. So we look at about 20,000 deals a year, about 5,000 a quarter, and we invest in 15 new portfolio companies a year. So we're pretty selective. We're not some of the mega funds, they'll do about 80 to 100 investments a year. We're a lot more snipery focused. So we look at more deals than a mega fund. Most funds look at like 3,000 to 5,000 deals a year. We're looking at 20,000, but we're about 10 times more selective for the deals that we do invest in.
Got it. And when it comes to deal sourcing, is it basically coming from your network? Because that's the case mainly for us.
Yeah, I think on our side, it's a mixture of certainly both. If you're hitting 20,000 deals a year like we are, you have to kind of do all channels effectively. But we have optimized for, I think, human capital management. Everyone on our team effectively gets assigned about 150 companies per quarter to engage in. And so that is one systematic way that we're making it, that we're getting full coverage. But we certainly have a lot of inbound, like the way that we got into Figure. One of the people that graduated from Venture University 3 years before, he built a relationship with the prior lead investor called Parkway VC. And so we had early allocation to Figure before the whole market even knew that Figure was happening. And so in that round that happened a year ago, it was 675 million, largely taken by strategics like OpenAI putting in 100 million, Amazon putting 100 million, Jeff Bezos personally putting in 100 million. And there's actually a very small allocation available for VCs. We came in for a little over 1 million of that 675, but we only got that because of our direct relationship with the prior lead investor. And so, yeah, certainly proprietary relationships matter, especially when you're trying to get exclusive allocations. Like for Anduril, and Neuralink. Like we've been waiting for the Neuralink round to happen for about a year, and so we've been building up our due diligence on that opportunity. So and I'd been kind of warming up core relationships. I knew we're going to get access to the financing round for Neuralink that just happened, but it wasn't going to be open to the public, and it wasn't going to be a lot of platforms. So you had to be on the inside to really get access to Neuralink. But once it happened, the Neuralink round happened in about 1 to 2 weeks. So like if you can't move fast, you can't get into some of these really large deals. I think that's a frustration that some of our investors have is that, we'll have the opportunities available on our syndicate platform for about a week to 2 weeks, and then it's gone. So unless you can wire within a week or two, you're not going to get in on some of these deals. So you need to be ready to move fast. And I'm just, it's a privilege to also create these allocations that are truly proprietary, and in many cases at significantly better fees than what they could normally get on some of these other marketplaces.
I've seen that as well, being on the distribution list of venture universities. Super interesting opportunities, but super fast paced. I mean, that's the American game. I mean, for Europeans as lazy as we are,
Yeah.
it sounds like let's be, to be honest with you.
Yeah.
But fair
I
enough.
need a few like coffees to think about it before I decide. So,
Precisely. Any other questions from the audience to Sky? I guess then I don't see any more. We leave it at that. We did 15 minutes in an efficient way. On a personal note, thank you very much indeed for the insightful discussions. I appreciate it. It was a pleasure. Thanks for the audience for joining. Thanks for the good questions. And we follow up as usual with some more information about venture universities for all the registered participants. And again, thanks everybody for joining. Have a great rest of the day. Take care, guys.
cool.
Bye-bye.
Thanks, everyone.
Ciao, ciao.